Hello, it's John Burford, and this is a short video introduction to the Elliott Wave theory. At least a few of the principles I'll show you that I use in my own trading. Now, the Elliott Wave theory is a massive endeavor. Many people spend lifetimes studying it, and it's by far the most complex method that I use. But before you run away, I'll tell you that I only use a few of the very basic concepts, which I think many traders could well get grasp and use for your own trading. Okay, now I've been studying it for several years, and I still regard myself as an amateur, and many traders don't touch it at all. It's just a bit too complex and it seems a bit arbitrary, but I hope to show you that there are ways of using this theory to your advantage. Now, I'll just say that a couple of the principles and a few guidelines I use have given me some very useful forecasting ability, and it's just one more tool to add to my toolbox. And by the way, it was one of the tools I used to identify the recent $1912 high in gold, for example. So it's well worth trying to get a grip on a few of these very basic concepts. Okay, well, it was Ralph Elliott in the 1930s that made the very basic discovery of the two principles which I use. Principle number one, and I'll refer to a bull market, and of course everything is reversed in a bear market. Okay, principle number one, from a low to a high, the total move occurs in 5 waves. 3 up and 2 down, and the 2 down ones are called corrective waves. Now after the 5th wave, the trend reverses. This is a very crucial point. And the principle number 2 I use is concerning the corrective waves. Now they most commonly take the form of a 3-wave pattern, or ABC as I call it. Now wave C is at least as low as wave A when we're talking about a bull market, remember. So I will show you a few of these on this very long-term Dow chart here. Now, by the way, these principles apply in any time frame from the 1 minute to the monthly. So it's a universal concept. So let's start off with this the low here back in March of 09, this 6,400 area low of the Dow. That was the big plunge low. Now from that point we embarked on some rallies, of course, and this is the form of the rally. It looks pretty arbitrary, but when you study, let's say this part here, let's take this part there to start with, you can see, I think, that we have some waves, some larger waves. The larger waves are these here, that one, that one, that one, that one, that one. In between there are minor waves. Now if we go up here, we can call this wave 1. This is a correction in wave 2, a big rally in wave 3, a correction in wave 4, and a new high in a wave 5. So there we have the illustration of the first principle of Elliott waves that I use. And I'll show you a little bit later in this video how I actually use them to my advantage in trading. Now, the interesting point is these waves here from these corrective waves. This is the wave 2 down here. Let me just see if I can give you a bit better detail. Let's move that up a bit. Okay. So from this low here, we made wave 1, and wave 2, if you notice, occurs in 3 waves, A, B, and C. Wave C lies under wave A, so that obeys the rule that I've just mentioned. This wave 3 here goes up to here, and wave 4 is in 3 waves, A, B, C. Wave C lies below wave A. So right away, in this example here, we have all of the guidelines, all of the rules being obeyed for Elliott wave theory. And you see, after wave 5, we had a big plunge, which culminated in the flash crash, if you remember, last May. So that was a big correction. It happened in one day. But looking at this huge wave structure here, overall, we've got all of the guidelines and the rules being obeyed for Elliott waves. Now, in retrospect, of course, we can all find the waves, and we can be geniuses at it, of course. But in real-time trading, it is always a lot more difficult, of course. And the wave count, as I like to call it, can seem quite arbitrary. Now, you've seen, if you've been reading my emails, that my provisional Elliott wave counts have been wrong some of the time, and so I've had to reassess. That is very common in using Elliott wave theory. But of course, I don't use Elliott wave theory alone. I use it in conjunction with the other methods that I'm going through in these videos. Okay, there's a few guidelines, as I mentioned, and I'll mention them now, that a third wave is very often the longest and the strongest in the sequence. So here's the third wave here. As you can see visually, you can see right away it is the longest wave in the pattern, and it is the strongest. It's the most relentless, I call it. It's a relentless move up with these minor corrections here. But by and large, anyone buying, anyone long, wouldn't need to worry too much about their positions. The other guideline is that fifth waves, and of course this is the fifth wave in this particular sequence, is an ending wave. Now, since I'm a bit of a contrarian trader, I'm always looking for reversals of trends. So I'm looking for fifth waves because I know at the end of a fifth wave that the trend will change, and will change quite suddenly very often. And now the problem is, of course, in real-time trading, if we're trading around here, we are challenging this high here of this wave 3. Now, any of these points here could potentially be the end of wave 5. And that's the difficulty. Picking tops is notoriously difficult, but not impossible. Okay, now what I'd like you to do, if you're interested in pursuing this, is to go over your charts in any time frame whatsoever, from the 1 minute to the monthly, and see if you can spot the 5 directional waves and the 2 corrective waves. I think you're going to be surprised at how often these patterns show up. Now, okay, that's theory. How do I actually apply it in practice? Right. Now, if you're trading down here in real time, you have no idea you're in a wave 1, of course. But by the time you get to here, and you see a big correction, and a little rally, and a new low being made, which is underneath that low, I think you've got an idea that you're in an ABC correction. With that knowledge, you can actually start looking to go long anywhere in this zone here. And corroborating evidence, of course, if you look down to the momentum, I always follow momentum on my charts, is that wave A, this is wave A here, the momentum was at this level, and wave C, the momentum was slightly higher at that level. So there you have what I call a positive momentum divergence, and I'll go over that in another video. But that's a corroborating piece of evidence to suggest that the wave C is ending here, and to get ready for a resumption of the rally. So that's one way I use the Elliott wave theory. I'm looking for C waves in a corrective wave sequence to go with the trend, the original trend. The other key trading point is fifth waves. I'm looking for ending waves here, and looking for reversal. So I like to go short when I feel, and the evidence stacks up, that I have the fifth wave identified.